why the market in Q1, why the market looked realer weaker than it really was. So it was interesting to me because if you just watch the news, if you just see, if you're a headline surfer, you look at it and you say, okay, the market was down for the first quarter of the year. But there was way more than that going on in the internal. So as we wrapped up the first quarter of 2026, right? The
Hmm.
headline numbers for the S&P 500 looked kind of concerning, right? The overall market dipped to basically a yearly low in late March. And that made a lot of headlines. Obviously, a lot of it had to do with I'm sorry, with Iran, but the headlines make it seem like it was really bad. So I would talk to people all the time. They'd be like, "Oh wow, what do you think of this market?" I'm like, Okay, it's down 3% from, like let's put this into perspective." But many listeners probably noticed the big technology stocks pulling back, which felt worrying because those names have driven a lot of the market's gains in recent years, right? So, and this is probably especially true for those investors out there who are probably over concentrated in the Mag 7, and just by virtue of owning just the S&P 500 index, you're over concentrated to the Mag 7, right? So it's not necessarily a conscious decision sometimes for people to be concentrated in the Mag 7. They just are because they own the S&P 500 index
Hmm.
in like a 401k or something. But when you look under the hood, right, the market actually wasn't as weak as the headline suggested. So, a simple way to see this, what I'm talking about, is through something called a moving average. So, what's a moving average? It's basically just the average price of a stock or the overall market. I'm going to talk more about the overall markets in some sectors than I am individual stocks. But it's basically the average price of something over the past 20 days, 50 days, 250 days, 200 days. So you'll hear people talk about the 200-day moving average, the 50-day moving average. Those are kind of the popular ones you'll hear people talk about. Okay. So what that does when you average 50 days or 200 days together is it smooths out all those daily ups and downs. So you can truly spot some sort of trend. So you look at a 50-day moving average, you're seeing what is the trend smoothed over 50 days. Same thing for 200. Okay. So even as the broad S&P 500 index hit that low, more individual stocks were holding above their recent moving averages than you might expect. And we saw positive signs in the daily count of stocks rising versus falling, which was interesting. So that mismatch generally hints that selling pressure could be easing. Okay, so for some context, the S&P 500 finished the quarter down roughly 3.5%. Yet several defensive and economically sensitive sectors performed much better than that, right? Oh, wait, what? You say yeah, I mean there was underlying strength across several sectors, and I'm going to use those sectors as tracked by State Street's Spider ETFs. Okay. So first one, energy. Shouldn't be a big shock to anybody because what was going on in Iran and with the Straits of Hormuz, the energy ETF surged 33% for the quarter. Okay. So S&P down 3.5, energy sector up 33%. Boosted obviously by higher oil prices and amid
Yeah.
these global events. Okay, fine. Great, Dave. Energy, got it. There's this event going on. That's really not all that impressive. I kind of expect that anyway. Great. How about materials, right? Ticker
Hmm.
XLB, X-ray Lima Bravo. Okay. The materials sector rose between 10 and 11% on the quarter versus the down 3.5 on the overall S&P. So materials, I mean, what, right? And then utilities and consumer staples, the XLU X-ray Lima uniform and XLP X-ray Lima Papa also posted pretty solid gains in like the 6 to 9% range, right? And I think that was, you know, thanks to more stable demand here at home. And then finally, the industrials, XLI, X Ray Lima, India. I mean, that held up reasonably well too. Meanwhile, many companies across the market and even in some in the technology sector, which was, pretty much what people were feeling the pain with. Those companies, a lot of those companies were actually revising their profit expectations higher, which is one of the
Mhm.
great things about stocks. And I think we're probably going to get into some commodity stuff here later on, but the profit expectations going higher are really good for stock, individual security, and sector buoyancy, I'll call it. Because if the profits are expected to be higher, stock prices generally go up as well. So while popular tech names were grabbing a lot of the attention on the downside, these other areas really provided some serious and real support across the
Uh-huh.
market, and that suggested that the market's internal health was actually steadier than the surface numbers imply that you see in the headlines and the news